So to anybody joining us now, just feel free to introduce yourself in the chat box and tell us where you're tuning in from. We've got quite an eclectic international audience, so it's always nice to know where you guys are coming from. And remember to switch to all attendees so everyone can see your messages. So hello Finimizers, welcome to another Finimize Live. My name's Luke, analyst at Finimize, and I'm hosting today's event on alternative ways to invest in real estate with our partner Cufflink. Just a few housekeeping rules to run through. This is a 15-minute conversation followed by a 15-minute audience Q&A. Use the Q&A box to ask a question, not the chat box. And if you see a question you like, remember to upvote it so it moves to the top, and that way we can get through the most upvoted questions first. Okay, let's kick this off. So our event partner for today is multi-award winning peer-to-peer platform Cufflink. They offer investors the opportunity to generate attractive returns by investing in a select asset-backed loan or diversified asset-backed loans. Their platform provides a unique opportunity for investors to receive higher returns than they traditionally receive from savings or investments. Their innovative online platform, you can lend against these loans secured against UK property, offering returns of up to 9.73% gross per annum. With Cufflink, you earn interest while you sleep as your money works for you. So today I'm joined by the captain of the ship, the CEO, Narinder Khattoare. Thanks for joining. How are you doing today, Narinder?
Yeah, thank you, Luke. Thanks for having me on. That's a great intro, by the way. Thank you very much.
It's a pleasure. Well, do you know what? We've got a full stack of questions today, so we're going to dive straight in. So Narinder, obviously, it's a real estate investment sort of business. So I think the first question I'd like to ask are your loan books stress tested for adverse scenarios? We saw that last year with the mini budget, the crisis, a spike in rates. So yeah, I'd be really interested to find out more about that.
Yeah. So yeah, it was an interesting time for all businesses and the economy with the change of policy with Liz Truss and Kwasi Kwarteng. So yeah, so look, we have a loan book. We have a credit committee independent that will look at the loan book scenarios. So just like a bank would do, we'll put the book through various stress tests. So i.e., what does the book look like on a 90-day value, on a red book value? And what does it look like if we were to do a fire sale on the book right now as it is? So it's stressed quite heavily. We'll look at various scenarios, so upward turns in the market, downward turns of the market, base rate changes, outside impact, things like war, cost of living, etc. as well. So it'll go through various different scenarios where we do stress testing on the book. So the key thing for us as a lender is, we're doing the best thing we possibly can. There's only a certain amount of control that we can have on the book, but there's certain things that, things happen in life which we just can't physically control. But we do as much as we possibly can in terms of limiting our loan to values and bringing in a bit more stress on the book and lending criteria as a whole.
I think that's really important to do that because the sun doesn't always shine. So it's really important for all those different scenarios that you laid out there, Narinder. Right, next question. How can investors sort of evaluate the different real estate opportunities? What are some of the resources they can look into and utilize?
Yeah, I mean, look, I'm not here to give advice, right? So if I'm now sitting as an investor, if I'm looking to put money or deploy money on any platform, the key things that I will look at is I would look at various platforms, the likes of Zoopla. I'll go on to Rightmove and see what the sold house prices are doing. I'd have a look at the area that the loans are available in. So i.e., are there shops that are looking to go into the area? Are the banks moving out of the area? What are the schools like? What are the opportunities in the local area? Because if the area looks to be booming, then the property prices are going to be booming and the links going into the major cities. So there's various factors that you've got to look at. And I think those are key for any investor going into any platform or doing any form of investment. You've got to do your own due diligence.
No, that's wise advice there. How much of an overall investment portfolio should one be allocating to, this? I know obviously it's different for everybody, but on average, what would be a sensible sort of allocation to an investment like in Cufflink, alternative real estate sort of sector?
Yeah, so any savvy investor would not deploy 100% of their investment funds into a platform like ourselves, right? You know, it would be lovely if we could get somebody who had £500,000 want to deploy that full £500,000 with us, but a savvy investor just wouldn't do it. So you'll have three separate pots, right? So one will be a high risk pot, one will be a medium, one will be a low. We like to see ourselves in the low risk category because, you know, you're doing loans which are backed by real estate. You'll have a first charge against a property, which is geared around 60-70% loan to value, right? So that's a low risk pot as far as we're concerned. Some people might put us in the medium risk pot, but we see it as a low risk pot. You've got other opportunities that you can deploy your money into: stocks and shares, equities, renewables, etc. So crypto, which is, you know, very high risk category, but high risk, high reward. You know, one thing which we know, and we've worked quite heavily in this sector for a while now, that, you know, the longevity of the property market, you know, you might have a few dips in it, but overall long-term strategy, you will grow money, you will grow that portfolio and you can grow your money within it.
And I suppose the nice thing about the property sectors, the returns are far more stable and consistent. They're more forecastable. Whereas like a thing like crypto, as you said, it can bounce up and down, and cause you many sleepless nights.
You got regulation there as well, Luke. So, you know, we're in a regulated market in terms of the investment platform. Whereas, you know, I'm not going to divulge into crypto, but it's an unregulated market, you know, and you can have outside factors, not to mention a certain somebody that lives out in the US that can actually really manipulate the crypto market, and, you know, you can see big spikes in the crypto. So people will make big gains, and there's going to be people that are going to lose a lot of money in that as well.
100%. Speaking of what you're saying, you'd love to get like $500,000. And what is the minimum investment for someone in that wants to potentially look at Cufflink investing on the platform? What is that minimum hurdle?
Yeah, so we set the platform back up in 2016, and we always said that we wanted an entry point for retail investments, retail investors to come in and invest money on the platform as well. So at the moment, you know, the minimum investment is £100, and you've got options. You can put it all into a specific deal, or you can diversify that £100 across a number of different properties in our auto invest product.
Okay, that's really manageable. I think that's great.
Yeah.
So you'll get far more
but
retail
we are
investors.
just on that, Luke. But there is plans of us potentially looking to up that minimum entry point at some point in the future as well. So we haven't actually kind of decided exactly what that looks like, but, you know, for investors out there, that entry point will move at some point later on in this year.
Okay, and obviously it's still early days. Is there any rough ballpark figure that you could give, maybe that would scale up to?
Yeah, I mean, it could be anything between £1,000. You know, we're not going to take it from £100 to £10,000 or £20,000.
Okay.
We still want some element of retail investors to be able to invest money into it. They'll be moved, but it won't be, you know, massively moved where retail can't invest into the platform.
Okay, fantastic. And just zooming getting into the nitty gritty of these sort of property investments at Cufflink, what's the average life of the loans? And in terms of borrower defaults, how does Cufflink protect its investors?
Yeah, so like a typical loan in the bridge and development market will range anything from 3 months to 24 months, right? So that's a typical. On average with us, they stay on the books anything between 9 and 12 months. Obviously, there's been a bit of a challenge, and I'll address that issue right now before somebody else picks that up as a question, because there's a lot of reterms that are happening in the marketplace, and that's due to the base rate moving up to 4.5%, lenders moving rates around where they need to feel comfortable lending to the borrower, to the borrowers, and people got to think about their own strategies that they have in place as well. I mean, a lot of people have been sitting on the current variable rates that they are, but they've got to make decisions. So do they lock themselves in and actually be realistic, because the market that we are in, and probably are going to be in the foreseeable future, is going to be those rates which are going to be around 3s and 4s and 4.5, maybe even going up to 5%. You know, when I first bought my house back in 2006, I borrowed, the base rate back then was about 4.5%, 5%. So my mortgage rate was at 5.5%. You know, I think we've had some good times here, and, you know, borrowers are fully aware that you've been borrowing at 1.5% and 2%. You know, that's not the norm.
Yeah. Okay.
And the same goes for in terms of default. So you mentioned defaults here. So
Yeah.
you're going to have people that are going to struggle to get out of their loan. So there's going to be some element of default involved. But what we do as a business, we work very closely with our borrowers. We don't go aggressive on them because we know what happened in the market. We know there's not a lot of lenders in the marketplace that are offering the deals that need to be getting them the money to refinance away from us. So we do work closely with them. So it's not, about us being very aggressive and getting that to recover that asset and put it into an auction where, the only person that's really going to benefit from that is the end buyer and the auction house, right? So we want to make sure that there's margin left in it for us, the investors and the borrowers as well.
Okay, great. And I mean, I guess another question would be like life circumstances change. So if someone invested money in Cufflink and they wanted to actually pull it out for some life circumstance, is there like an early early penalty fee for that sort of thing, or how would that work?
Yeah, so I know there's other platforms that don't operate or have a secondary market. So we've had a secondary market pretty much since we came to the marketplace back in 2017. So there is a marketplace there. It tends to do very well, particularly on smaller chunks of loans where somebody's looking to exit out. There is a fee associated with that, which is at 0.25%, which we think is quite competitive in the marketplace. So there is opportunities. Where you see challenges if somebody's deployed, £250,000, £500,000 into one deal and they're looking to exit on that loan. Those loan parts do take a long time to sell. So if anybody's looking to come in or to put an investment in, they should be doing it in smaller chunks rather than in a big chunk at one time.
Yeah. No. I would imagine that bigger chunk would be a bit harder to move. We almost time into the Q&A, but we've got a few more things we're going to run through. So how much longer, in your opinion, do you think investors could receive up to that 9.73% that I quoted earlier? I guess maybe just explain the mechanism of how that number's achieved. I assume it's some spread added to the standard mortgage rate, which is obviously a derivative of the BOE's bank rate. So yeah, just run us through that.
Yeah, so that 9.73 is a compound rate. So your money's locked in for a 5-year period, but those funds are diversified a number of different types of loans that we have in the pool at any one time. Sustainability in terms of paying those 9.73, I think, for the foreseeable future, it'll be there, particularly over the next 12 months or so, because the base rate is at 4.5. Chances are it may go up to 5 at some point. And, I don't see that rate coming down to anywhere near it was, 12 months, 18 months ago. So sustainability and paying those kind of rates is achievable because any lender that's lending in this marketplace, from a borrower's point of view, they've got to be in a short-term period is look at variable rates. So those rates will vary. They can go up as and when the interest rates go up in the marketplace, and to their benefit can go down as and when the base rate starts coming down as well. So particularly over the next 12-18 months, I could see those kind of rates achievable. Will it go into double digits? We won't. We're just not a lender that go into double digits. We never have, and I don't see us ever going down that road. I think that is the highest rate we'll ever pay on a fixed rate over 5 years. But that's a great opportunity, right? So where the market is at the moment, 4.5%, you can lock your money away in, compounded at 9.73% per annum. That's a great rate. In 5 years' time, I've got no crystal ball here to say that where rates are going to be in 5 years' time, but I'm pretty confident to say that they won't be where they are now. They'll be a little bit lower down, near the 3.5% mark. So that's a great spread for people to earn, especially when it's backed by real estate.
Yeah, definitely. I think 9.73 is a very good, healthy rate of return. What are some of the alternative investment opportunities in UK real estate, Narinder?
So look, there's different types of, real estate. So it depends on what everyone's risk appetite is. So, in terms of pure resi investments, there's opportunities there, especially now, right? It's a buyer's market. For somebody to go out there as a borrower, there's some great opportunities there for people to go and get some deals done. The challenge they have is funding, right? So they've got to work out whether I can get the funding at the right price. Can I put enough equity into that deal for it to justify? And then can I get the rent that I need to achieve for that actual investment to work? So there is opportunities out there, and there's other people who have pulled out of the market altogether because they're just frustrated with where the rates are. I know there's a lot of investors that we deal with and borrowers that are buying land and banking land at the moment, looking for development opportunities going forward over the course of the next 12, 18 months, where the cost of materials at the moment is so high. I know they're starting to come down slightly. So there is some opportunities out there as well. Same goes for commercial as well. So there's a lot of, opportunities there for some commercial, opportunities for investors as well.
All right, well, that brings us to the end of the sort of questions. We're going to go into the Q&A, what you as the viewers want to ask, and we're going to start off with Jeremy, upvoted. Are the vast majority of properties on the Cufflink platform in major cities or more rural areas? Do either of these perform better in returns on average?
Yeah, so what we try to do is we try to do deals where we know in a worst case scenario that as a lender that we can exit, right? So we know that if something's in a main city centre, that's going to move quickly than something a bit more rural. If we're going rural, we will look at a lower LTV. We look to minimise our risk on that type of an asset class. We don't do a great deal, but we do them. But we seem to get a greater uptake of the ones that are more in inner towards or very close proximity of a city centre.
Okay. Alrighty, perfect. And then Raj asks, is Cufflink similar to fundingcircle.co.uk and assetscapital.co.uk?
Yeah, Funding Circle, no, because they're predominantly an SME lender. I know they went into the real estate lending for a very short period of time and they exited that market. I think they only lasted 6 months in it because their forte is just to lend against SMEs. Assets Capital, yes, very similar to what Assets Capital do, and it's all real estate, development loans, etc. But I know Assets Capital do SME lending as well. We just don't do SME lending. Ours is just pure bridge development finance against real estate, UK real estate.
Okay, fantastic. And then I guess Nikolai wants to know, what's the main benefits of investing in peer-to-peer rather than buying property with loan, a part of the low entry level?
Yeah, so it's you're investing in a property without actually owning it. Owning a property comes with its own challenges, right? So I'm a landlord myself. Problem is, getting the gas safety certificates done, the boilers, something goes wrong with the property. You've got to have tenants. Are the tenants right? Are they paying are they paying on time? It's a lot of stress being a landlord, but there's a big reward in that as well over the long term because you build some equity in that property. I think it's down to each individual. What do they want to do? If they want to be hands off, a peer-to-peer investment is a great opportunity. You're diversifying your money across a number of different property loans without minimum, involvement in the actual process. But there's some great opportunities in the property market as an investor as well. So it's entirely down to each individual what they see, best for themselves.
Great. Okay. And then going back to the BOE, we've got a question here from Camilla that says, when BOE rates were close to zero, a 9% per annum was impressive. With current 4.5%, though, it leaves us marginally better off than traditional alternatives after tax. Are rates going to move up corresponding to the BOE?
I think I've kind of addressed that earlier. So our top rate that we'll probably pay is 9.73. Even if the Bank of England base rate goes up, I could see a slight little tweak in it. I don't see it going up further than what it is. I think it's priced right for the kind of asset class that we're lending against and the risk that comes with that as well. I just don't see it going up from our side.
Okay, great. And then Richard would like to know, what is the difference between this investment over REITs?
Yeah, so in terms of investments, look, you're in control with this, right? So this is the key thing with us as a peer-to-peer lender. So you're in control of what you do. You can go in and you can definitely control where your money goes. And there's loads of other places that you can go and put your money in, and you just can't see physically where your money goes. The other thing is you can actually physically talk to people here as well, right? So we've had a number of investors that have come our way because they like the way we are, the way we operate. You've got to put a face to a name. You can physically talk to people and you can see exactly where your investments are going. And on top of that, you can ask questions regarding those investments. Where was the logic behind that? We give commentary, on these investment classes. You can see a valuation report. And if you've got queries on the valuation report, you can pick up the phone, speak to any one of our investor relations team and talk to them. So it's more of a physical conversation that you can have compared to, other areas of investments as well.
It's perfect. And then Anna would like to know, how can I work out if peer-to-peer investing is right for me? Do you have any resources I can look into?
I think the key challenge, not the challenge. So the thing here is do your research, right? So look at what the other peer-to-peer platforms are doing in the UK. Have a look at who they are. Pick up the phone, talk to them. Look at their company accounts. Look at who they're audited by. And look at their business, the company accounts. So that gives a true reflection of where the business is. Are they being independently audited? Do they have independent non-executive directors that operate within the business as well? You will see a range of different types of platforms in the market. They give you different types of opportunities. Some will pay you less than what we're paying you. Some will pay you more. It's down to you, yourself to do that individual and feel comfortable with where you invest. I'm not going to sit there and say we are the best in the marketplace. We're not the worst. We are very well established. We've been doing this since 2016. Then 2016 launched as a platform in the UK. We're regulated. We have our council which are independently audited. No investor at the moment has lost any money on the platform, which performance is very good. Rates are realistic. Asset opportunities that you can invest in seem, very attractive for most of the investors. And what we find is, most of the investors that come to us tend to stay with us for the long haul. But we are one part of 2 or 3 of the investment strategy. So they will have other places. Some of our competitors, they will put money into them as well, which is sensible, as they should do. And on top of that is read our Trustpilot score. So, we've got a lot of investors that go on Trustpilot give us very positive reviews. Go and read that and do your research.
That's still advice. So I think this is quite actually interesting. We've got a terms of geographic location of where Cufflink invest. Jay's asked, do you predominantly invest in UK real estate only or international real estate as well? And if you do invest in international, is there more risk involved?
Yeah, so we've only done UK real estate. We've looked at going into Europe, going into a different jurisdiction. It comes with all different types of implication when it comes to law. We're just not geared up for that. I'm not saying that we're never going to do it at this moment in time. Over the course of the next 12, 24 months, there is no plan to go abroad. What we're looking to do is be more established in the UK than what we are. I think we're quite well established at the moment, but I want to become more of a household brand name with investors so they can get really confident. And when we get to that stage where we've achieved what we want to achieve as a business, then there's going to be opportunities for us to look abroad. I mean, I know some of our other competitors have looked at doing it abroad and have actually gone abroad as well, which is great for them. For us, the foreseeable still is to remain in the UK.
Okay, so focusing on the UK and trying to become a household name here. That's fantastic. And then Kevin H wants to know, he recently joined. Can you confirm the interest rate being 9.73% compounding each year, fixed for 5 years?
Sorry, could you say that again?
No problem. So Kevin H asked, and he recently joined, so I think you might have missed in the beginning. Can you confirm the interest rate being 9.73 compounding each year, fixed for 5 years?
Yeah, so that's a compound rate. It's an auto invest product where your money's diversified across a number of different types of loans in the pool for fixed for 5 years.
Okay, perfect. All right. And then same Kevin H asks also, what is the future of commercial real estate? What is your views in that market?
That's an interesting one. So there's opportunities there, right? I think there's been challenging since the pandemic, because there's a lot of commercial businesses out there, where majority of staff are now starting to work from home. I know there's a lot of businesses that are not looking to renew their leases. So there's some opportunities there. But I think it just needs a product that actually works for the borrower and the lender to think that is it the right type of asset class for us to go forward. So I don't want to say too much on this at the moment, but there is a product that we're potentially looking at for the commercial space at the moment in its discussions that we are having internally. So for us, from my side, is watch this space from us and see what we're doing over the next 6 months. I'm very confident that we'll have something there which will be quite attractive for investors. But it's got to be a product which is right. So which is right for us as a lender and right for the borrowers who's borrowing the money, and right for the investors to put their money into as well.
Okay, perfect. Well, sticking with that theme of that sort of entrepreneurial thing, we've got a question here from Richard who asks, what are your plans in terms of scale for the business in the next 5 to 10 years, and what challenges do you face?
I think for us it's products, right? So we've explored looking at other products. We launched a buy-to-let product last year. Unfortunately, the crazy events of last year with the mini budget, made a lot of businesses think twice about where and what their product set looks like, right? So we pulled that product straight away because it just didn't work for us on that trajectory that we are working on. We are working on separate other products. One that I've said to you, which is commercial. There's a couple of other ones that we've explored, which is more personal type lending. We've looked at SME type lending as well. So I think going forward, the bridge, the bread and butter for us is still always going to be, short-term bridge and development finance. That will always be a part of the business that we'll always do. I think there will be other types of products, the likes of an SME type product that we'll add onto the current lending opportunities for investors, and a commercial product as well. So as a business, we've always liked real estate, but there are other opportunities for us to go out there and add different types of products to our current portfolio that we have as well. But the key thing for us is, do we have the expertise in-house? If we don't, then we'll have to think about bringing people from outside in that can help us to achieve what we want to achieve. But the key thing is, do we feel comfortable? Is that if that's the industry that we want to go in, we've got to make sure that, is it right for us as the business? Do we have the right investors on the platform that want to invest in those types of deals as well? So that's another challenge. And then that opens up doors for potential institutional funders to come into this space as well, because I know there's a number of platforms out there. We're not one of those at this moment in time that have an institutional facility. We're purely funded by our investors on the platform. So there's opportunities to do bigger loans as well, but I know there's an appetite where some investors don't want to go over a certain amount invested into a particular type of deal. So that holds a business like us back into doing some of the bigger deals. But watch your space.
I like that. Watch this space. We've got a question from K.A. Mohammed who asks, what if property values drop? How does that impact the rates? I assume that's rates of return.
Yeah. So look, ours is a fixed rate, right? So, any loans that we've lent out to any borrowers, there's a fixed rate in place. There's no variable rates on that. But going forward, the way the market is at the moment, variable rates are inevitable for most lenders. So if Mohammed was there to put in an investment into, say, I don't know, a real estate project for 12 months at, £1,000 against, say, asset, where he's earning 7%, he's going to earn 7% unless the market turns massively, where there's a massive drop in the LTV, which takes away the equity in that property. I've been operating this space for a long time. I've not seen the market move by like 30-odd%, drop. And I don't see it happening going forward. I mean, I think prices have kind of stabilized, in terms of equity-wise where it should be. But majority of the lending that we do is sub 70% loan to value, right? So we factor that in. So if we're lending to anybody, we always make sure that that person can exit. There's enough margin in it. And if we don't think there's enough margin, then we ask them to put a bit more money towards that deal, or give us alternative assets that we can put towards that, where we leverage across two different types of asset classes.
Narinder, I guess one thing that I find personally quite frustrating as somebody young that's trying to get on the property ladder is that a lot of the solutions in the UK seem to be very demand driven and not supply side. So building more homes and that sort of stuff. But even on the demand side, like for me, the US having these 30-year fixed mortgage rates, it just seems to protect the consumer so much more when rates are lower, and when they do need to hike them like they've seen in the US. And it allows the central bank to do their job and not worry about financial instability within the mortgage market. So why do you think the UK, to end things off, doesn't offer these sort of 30-year fixed mortgage rate loans?
So it's a very good question. I mean, that's down to the policymakers there at Whitehall, right? So it's a question for them. You know, if I come across them, I'll ask that question definitely to them as well. It doesn't help us, right? So, you know, to getting people on that property ladder, it's a challenge here in the UK, right? So we just don't seem as if we're protected enough as it is. So it's a difficult one. I mean, if I don't have the answer for that, Luke, it's a debate, you know, that, you know, people have had. You know, it's down to the policymakers. There's got to be some sort of group out there that can be feeding this back. I mean, and I know this in the associations that we're a part of, there is some feedback that goes into the policymakers, and you know, it's one of those. If I'm part of those, whether I do get invited to those, I'll make sure that those kind of questions are addressed, you know, and I get some answers for the group on that as well. But yeah, it's a difficult one.
Yeah, please do, actually, please do, because I've been scratching my head trying to figure out why they won't do it. Very interesting that the policymakers haven't, and I hope they do, because I think it would be very beneficial, particularly when rates are low. Maybe not where they are now, locking in that rate for 30 years, because I do think we'll see the cycle turn eventually. But do you know what? It brings us to the end of the session. I'm afraid that's all we got time for today. I could chew your ear off the whole day, Narinder, but I'm sure you're a busy man and you got lots of stuff to do. So thank you so much for joining us today. I found it super informative and interesting, and I'm sure our audience has too. So thank you very much.
Thank you very much. Cheers, guys.
Cheers, Narinder. Bye.